Right, so we've already discussed the questions and answers in the RTP May 19 for the old course and also for the new course, right? So as far as the RTP May 19 is concerned, we are now only left with the MCQs to be discussed over there, right? So we'll just quickly in this particular video go through the MCQs which are given in the RTP, okay? Right, so first RTP May 19 for the old course. Right, similar MCQs in the old course and new course except for one MCQ which I'll cover it later. Right, so first one, AJ and Company LLP is a firm of chartered accountants. The firm has 10 partners. The firm has a good portfolio of clients for statutory audits, but the same clients had some other firms as their tax auditors. In the current year, many existing clients for whom AJ and Company LLP happens to be the statutory auditor have requested the firm to carry out their tax audits as well. The firm is expecting that the number of tax audits to increase significantly this year. One of the partners of the firm has also raised a point that the firm can accept tax audit up to a maximum limit. However, other partners are of the strong view that limits on audits is applicable in case of statutory audits and not for tax audit. These needs to be decided as soon as possible so that the appointment formalities can also be completed. You are requested to advise the firm in this matter. Right, so this particular MCQ is on a technical point, right? There is no understanding required. It's like do you know the fact about it, the technical aspect. What is the limit on tax audit assignment? 60 tax audits per partner, right? So if there are 10 partners in the firm, so the firm can accept in total 600 tax audits. Right, and also what does ethics say? Can one partner of the firm sign all the 600 tax audit reports? Yes, assuming that the other 9 are not signing any in their individual capacity, one partner of the firm can sign all the 600 tax audit reports. Right, so 4 options, there is no limit. All the partners can sign 450. So earlier the limit for tax audits was 45 per person, per CA. Now it has been increased to 60. All the partners can collectively sign 600 tax audit reports and all the partners of the firm can collectively sign 450. However, one partner can individually sign maximum 60 tax audit reports. Right, so the correct answer in this one is C. Right, all the partners of the firm can collectively sign 600 tax audit report. So I very much you can say that this question could have been a one-liner question also, but to give it that case study effect, the feel they have created so much story around it. Okay, second one is the more interesting. It looks like, oh, what has happened in this question? Right, Ram and Shyam Company LLP is an audit firm of CAs with Ram and Shyam as the audit partners. The firm has various statutory audit and internal audit engagements which are looked after by Ram and Shyam respectively. In the previous year, one of the audit engagements of the firm was picked up for peer review and the reviewer raised various observations regarding the audit documentation. Some of the information was missing from the audit file as per the observation of the reviewer. Okay, so what they are saying, first one is doing stat internal audit, then after that peer reviewer found out that few documents are missing. Right, Ram and Shyam are in the process of establishing a robust mechanism for audit documentation. So now you remember, okay, documentation. So that the same is available for a long duration and it would lead to audit efficiencies also in the future years. Ram and Shyam would like to understand the period for which audit documentation should be maintained by them as per SA 230. Right, so how many years audit documentation to be retained by the auditor? 10, 9, 8, 7. Right, so again a factual question, right? 7 years, not less than 7 years. Books of account are required to be maintained by a company for 8 years. Right, audit working papers, audit documentation is required to be retained by the auditor for not less than 7 years from the date of the auditor's report or from the date of the group auditor's report. Okay. Right, so easy one, 600 tax audit reports, then 7 years. Right, next one, KJA Limited is in the business of manufacturing of tiles and sanitary ware. So, when we say 30 marks of MCQ in the exam, and if this is going to be the size of the MCQ, the question in the exam, the question booklet, itself will look like a big, like a policy guide or something, it will look like a pamphlet, a big pamphlet, brochure type of, big detail one, 20-30 pages type. Okay, and then reading so much of MCQ, so you can't directly read the last line in the question, though that could be an option as a, as a backup plan. If you have less time, then you can read just the last line in the question, but that is like just, probably read the last and then again start reading from the beginning also. There's one more question which students have, that should I solve MCQ first or last? So obviously I would recommend that you should solve them in the beginning, right? You should read them in the beginning. So first 15 minutes strategic time, you read the entire paper, and then after that when you start solving the paper, you start with the MCQs. Why? Because one, that if you know the answers, you've already scored marks, you've devoted time to that important scoring part of the paper. And second, if you're confused, so when you're writing the remaining part of the paper, something might click you regarding what is the correct answer, and then you may rub A and make the answer B or C over there, something like that. Okay, and if you read it towards the end, then after coming out from the exam hall, when you start studying for the next paper, then you will remember. Right, so my recommendation to you is that MCQ should be solved in the beginning of the paper. Okay. Right, let's read the question. KJA Limited is in the business of manufacturing of tiles and sanitary ware. The company has large inventory. Annual turnover is 3,000 crore. The company has 7 plants across India. The management of the company carries out physical verification of inventory every year at the time of the reporting date. During the year 2018, it was found by the management that inventory sheets, right, of 2017 did not include 5 pages containing details of inventory of 24.5 crore. Management has included this inventory in the valuation of inventory on 2018. Management has also explained that considering the size of the company, this may happen at times as the inventory is huge and lying at various locations. Moreover, the amount of inventory is insignificant, 3,000 crore turnover. No, if considered as a percentage of the revenue or inventory. State how will you deal with this matter as an auditor in the accounts of the company towards substantive audit procedures and excluding the impact on the auditor's assessment, including the internal financial control framework for 2018. Right, so since the matter is not relevant to current year, no reporting is required in the audit report for 2018. Management should restate the financial statements to adjust the error, otherwise auditor may modify his opinion on the current year considering materiality. Considering the matter is not relevant material to the current period figures, the management may include a note and basis that no reporting in respect of this matter would be required in 2018. Include an emphasis of matter because of the effect or the possible effect of the error in the audit report for 2018. Right, so that cannot come in emphasis of matter paragraph, right? Not that saying it is not relevant to the current year, so no reporting in the current year. No. A also, what does it say? No reporting in the current year. No. A, C, D, all wrong. So what is the correct option? B. Right, management should restate the financials to adjust the error. Otherwise, auditor may modify his opinion on the current year considering materiality. Yes, fourth one. IRC Limited is in the business of construction and infrastructure. The company is listed in India and having a turnover of 2,500 crore. The company has various project offices operations in India and outside India. The functional currency of the company is INR. The company has 5 joint ventures and various jointly controlled operations. The company has been audited by Luthra and Associates, a firm of CAs since beginning. 2018, new auditors were appointed for the company. New statutory auditors have raised various points relating to the consolidation procedures followed by the company. Management did not agree to the observation of the auditor as they have been following this since many years now, and there was no observation of the previous auditors in respect of the same. Auditors have highlighted a point, so now this is the crux, that joint ventures have been consolidated by the company in the standalone financial statements. However, management has an argument that those are in the nature of its operations and hence to reflect the true and fair view, it would be appropriate to consolidate the same in the standalone financial statements. Please advise as an auditor, how would you deal with this matter? In your entire life, have you ever heard that joint ventures are consolidated in the standalone financial statements? Right? Have you ever heard of that? So since the matter is relating to consolidation, which is more relevant for consolidated financial statements, no reporting would be required in the audit report in 2018. Auditor should look at the materiality and conservatism principle. Company has included extra information in the financials which can be considered by the auditors, and basis that clean report should be given. Management should restate the financials to adjust the error relating to consolidation of joint venture and standalone. Otherwise, auditor may modify his opinion on the current year considering materiality. And as per the requirements of the AS, joint venture if consolidated and standalone should not be consolidated again in consolidated financial statements. Basis that this point would be dropped by the auditor. Right, so A, B, D all wrong, right? So what is the correct option over there? C. Next one. WCO Private Limited is a joint venture of WCO GmbH and MSON Limited. Now नाम ही ऐसे बड़े-बड़े रखे कि वो नाम फिर से पढ़ने में it will take more time. Okay, WCO GmbH is a company based out of Germany and is also listed in Germany. WCO GmbH prepares financial statements as per IFRS. MSON Limited is a company based out of India and is also listed in India. Right, so one subsidiary is a joint venture of GmbH and MSON. So GmbH listed in Germany, MSON listed in India. MSON Limited prepares its financial statements as per Ind AS. For the purpose of reporting of financial information to WCO GmbH and MSON for consolidation, WCO Private Limited uses reporting package which comprises of balance sheet, profit and loss and other notes. WCO Private Limited prepares its financial statements as per the Ind AS. Right, so WCO Private Limited prepares financial statements as per the Ind AS. WCO Private Limited has taken useful life of some of the fixed assets in its Ind AS financial statements based on their useful life, which is different from the useful life of similar nature of fixed assets taken by WCO GmbH. Right, so private limited company, different fixed assets useful life taken as compared to GmbH. The reporting package of WCO Private Limited is audited before reporting to GmbH. The auditor audits the reporting package which is prepared in line with the group accounting policy. Right, so generally for consolidation, joint ventures, we have a concept for following the same accounting policy across the group. There is a group accounting policy or manual which is issued. Right, of WCO GmbH and mentions in his report that the reporting package has been prepared as per the group accounting policies of GmbH. WCO Private Limited makes an adjustment for change in the useful life in the reporting package on the basis of the group accounting policies of WCO GmbH. Right, so what they are doing, as what is mentioned in the group accounting policy, accordingly they are customizing their accounting policy. The auditor has asked the management to take the same useful life of fixed assets in the reporting package which have also been taken by them in its Ind AS financial statements. Management has not agreed with the view of the auditor. Please suggest the right course of action. So one line what I understand is that WCO GmbH, whatever accounting policy, group accounting policies they have prepared, accordingly WCO Private Limited has followed those accounting policies. Right, in order to ensure that across the entire group the same accounting policies are followed. Right, so position taken by management is correct, position suggested by auditor is correct, and if management does not agree, modify on basis of materiality. Matter relates to estimate which may be subject to change under different gaps and hence auditor should ignore. The report which would be for special purpose, hence it should always be a clean report. So C and D is just for the sake of creating the option. And when you read it, you come to know this is too vague. So the competition comes in the earlier two. Right, so position taken by the management is correct and position suggested by the auditor is correct. So one of the two has to be right. But if you look at the chapter of consolidated financial statements and where they talk about different accounting framework, right, they talk about the group accounting policies being followed. And in this case, the group accounting policies are being followed. And that is why the position taken by the management is correct. Okay, right, are you still listening or are you all asleep? You're awake now at least? Okay, next one. DCHI Limited is in the business of optics and imaging products. It is a wholly owned subsidiary of a Japanese company, DCHG Limited. DCHI Limited has many expatriates working in the company whose tenure ranges from 2 to 5 years. During the course of audit of the financial statements, the statutory auditor observed that the company has not been deducting and depositing TDS on the salaries of expats. The auditors assess the impact of this can be significant as the company has many expats and the salary amount is significant. Management explained that TDS on salary of expats would lead to unnecessarily hassles to the expats and they serve the company only for a short period. Right? How should the auditors of DCHI Limited deal with this matter? Right. So considering this as a statutory non-compliance, the auditor should look at the significance of the matter and report in CARO. Considering this as a statutory non-compliance, the auditor should look at the significance of the matter and accordingly should consider reporting this in the main report along with CARO. So that's the difference, only in CARO or main report along with CARO. Auditor should agree to the management's view as expats are temporary workers and this may not be convenient for the management. Since the matter relates to statutory liability only, the reporting requirements do not arise till the time this becomes disputed. So C and D cut. Right, so the competition is between A and B, right? So obviously not only in CARO, first you do the reporting in the main report and then additional reporting requirements under CARO 2016, right? So the correct answer over here is B. Okay, next one. You have only 8 working hours. Oh my God, which article has 8 working hours? Okay, for raw material inventory verification. Based on your observation during these 8 hours, you have to form an opinion with respect to correctness of inventory value calculated by the management. The company uses ERP system for updating and recording raw material inventory. The ERP system of the company has passed all the ITGC checks, right, the general controls, right, and inventory rates are calculated by the ERP on moving average basis. The company has done ABC analysis of all raw material inventory items and has vast number of items in each category, ABC. You will form your opinion based on ABC analysis, check physical inventory of A class items and matching it with the ERP stock. B. Understand the process of recording of inventory in ERP to ascertain potential weaknesses and checking physical inventory of mostly A class item, some B class item and some C class item. Check physical inventory of A class item as much as possible along with certain B class and C class items on sample basis in value wise descending order. Compare the physical stock with the ERP system and tabulate the result. The exercise should be continued till the end of the allotted 8 hours. Check physical stock of only those items which have standard packaging so that verification is faster considering the 8-hour time limit. So D is anyways a filler. Okay, so now A, B, C, I think C is the biggest one. So that should be the correct one. Okay, so not because it's the biggest one, but it has got the correct procedure, right? So that is why C is the correct answer. Right, next one. Yes, 8th one. ABC Private Limited had a turnover of 39 crore as at 31st March 2018. The company had taken a loan of 39 crore from various banks and financial institutions. These loans were paid by the company before 31st of March. The company is of the view, ABC Private Limited, that the auditors reporting on adequacy of and operating effectiveness of IFC would not be required. The auditors of the company have a different view. What should be the correct option? Right, so in case of which companies the auditor is not required to do the reporting on IFC? So IFC applicable, but when is the auditor not required to do the reporting of IFC? Right, for private companies, which is a one-person company or a smaller company, right, or a private company having a turnover of less than 50 crore and having borrowings of less than 25 crore. Right, in the given case, though the turnover is 39 crore, that is less than 50 crore, but the borrowings at any point of time have been more than 25 crore and hence IFC reporting would be applicable to the company. Right, the turnover is below threshold, so IFC will not be applicable. Turnover is below threshold and loan amount was fully paid up, hence IFC not applicable. Turnover is below threshold but loan amount was above required threshold. Irrespective of the fact that loan was outstanding or not, IFC would be applicable. In the given case, because of the repayment of the loan, applicability of IFC becomes optional. So this is a filler. Right, so the correct answer over here is C. Right, next one. AS Limited is a manufacturing company and started its business in 2000. The profit after tax of the company was 15% up to 14-15, but for 15-16 and 16-17, the company's profit declined even when there was increase in the sales and production of goods by the company. So the management of AS Limited felt a need to get the management audit conducted with the objective of detecting and overcoming the current managerial deficiencies. What criteria do you think the management should keep in mind while selecting the management auditor for the purpose? Right, so qualifications and experience, courage to report the facts and relationship with the staff of the department that's functioning. Qualifications and experience, courage to report the facts, clear understanding of organization structure, working environment, understanding the purpose for which the audit is being conducted, healthy relationship with staff of department that's functioning has to be audited, and with the top management, and analytical skill. Management auditor should have the required qualification and experience only. The management auditor should have a healthy relationship with the various departmental staff in the organization and with the top management. So right, you know, this B has all of the points, and then A, C and D, they've just made small points from B part. Right, so again, yes, jokingly, B is the biggest one, so that is the correct one. Okay, so that has nothing to do, okay, because it's the biggest one. But yes, obviously all these qualities should be there. Criteria should be kept in mind while selecting the management auditor. Okay, last one on the RTP May 19 old course. The Advances Bank Limited has sanctioned overdraft limit of 44 crore to ASG Limited on the working capital as on 2015. As per the bank norms, the drawing power in the overdraft account needs to be reviewed on a quarterly basis as per the audited stock statement of the company. As a CSA for 16-17, while verifying the advances, you notice that the bank has not obtained the stock statement of ASG for 2 quarters, December 17 and March 17, and no provision of NPA has been made for this account in the financial statements. Right? What will be your decision as the Central Statutory Auditor, CSA? Okay, so accounts deemed to be irregular, right? When the stock statement is not submitted, right? It says maximum for 6 months. Right, then the account is deemed as irregular. Right, so what does it say? 3 months, more older than 3 months, right? So 90 days or further than, it says 180 days also. If the credit limit is not renewed within 180 days, right, then the account will be deemed as an NPA. Classify the borrower's account as an NPA. Yes, as the borrower's financial position cannot be determined, instruct the bank to obtain the audited stock statement for both the quarters and review the credit limit. As per the bank norms, the drawing power needs to be determined on the basis of stock statement, and it was more than 3 months old as on 2017. So the account and outstanding in the account will be deemed as irregular. You should give a qualificatory note in the audit report as per 700. So last one is again a filler. Right, and instruct the bank to obtain stock statement and review, but that is corrective measure. But right now, what is the action to be taken? Right, so the C is the correct option, right, deemed as irregular. Okay, right, then if I come to the RTP May 19 for the new course, okay, if I come to the MCQ part of it, okay, out of the 10, 9 MCQs are the same. Right, out of the 10, 9 MCQs are the same, only this MCQ number 9 is a different one. Which of the following is an example of a direct ELC? Right, so in the chapter of special aspects of auditing in an automated environment, you have the discussion over there regarding direct ELCs and the indirect ELCs. Right, direct entity level controls which help you to prevent, detect and correct the misstatements in the financial statements, the internal control, and indirect which do not help you to prevent or correct, detect any misstatement in the financial statements, but indirectly help in the effective functioning of the direct ELCs. Right, so you have a concept over there which is again a trending important concept, the direct ELCs and the indirect ELCs. So which of the following is an example of direct entity level control? Means all others are going to be indirect ELCs. Right, so ethics policy, human resource policy, business performance review, job roles and responsibilities of the employee. Right, so ethics policy, nothing to directly do with the controls. Right, so indirect ELC. Human resource policy, again indirect ELC. Business performance review, so this has got something directly to do with the controls in the organization. And job roles and responsibilities of employee, again it is an indirect one. Right, so the correct one is the business performance reviews, that is the C one. Right, the business performance reviews. Right, so that completes my entire discussion for the RTP May 19. So now I understand there are 4 videos on YouTube regarding the RTP May 19. right? The first video is regarding the amendments, right? So the tax audit, from GSTR 9C, all the company audit, right? Liabilities of auditor, all the amendments which are there are discussed first in that amendment video. Second video which you have over there is regarding the questions and answers in the RTP May 19 for the old course. Third one, the differential questions in the RTP May 19 for the new course. And now the fourth video, which is regarding the MCQs in the RTP May 19. Right? I wish you all the very best and thank you so much.